Thank you very much for attending to this. As you know, the debate here is about Europe and competitiveness. Before I get on to that, just relate to you, this is my second autumn debate. The first one was actually yesterday afternoon, when the subject was the abolition of the evil City of London Corporation. Because we are apparently control the world and we bleed third world countries, this type of thing. Clearly this wasn't a TheCityUK event. It was in fact on the steps of St Paul's with about 300 of the happy campers. And it was a little bit uneven. I'd invited myself, and there were three of the proposers and me, and 300 people. I think you can say I lost. But it was engaging. They thanked me for the debate, but I have a feeling their idea of debate was slightly different from mine. By the way, a more serious point, you will not get the questions from this type of group. There are no questions from that type of group. There are statements, but no questions. I do think the industry is going to have to create its own questions to answer, if you like. So I think that's a very important point. So if we can now come on to the subject of the opportunities and threats facing Europe, which is interesting because we're not quite sure who is and what is Europe. But maybe that will evolve as we talk through it. I mean, clearly any discussion in this area is going to have to take a view on the post-crisis structure and what we think will come out of that. And clearly the, if you like, German-French control, which is clear now through Merkel and Sarkozy and Lagarde, and as I say, what type of proposals we could expect there. Again, the financial transaction tax is, of course, proposed there. So I think there are lots of very interesting issues about Europe. I think, indeed, in some cases, it probably raises as much passion as the protesters have about the City of London Corporation. So without ado, we have a very wide-ranging panel here, as you can see. I'm sure that all of you will know them. And if you don't, well, there is a biography in the notes, of course. So how are we going to kick off on this one? Perhaps if I just ask the panel just to give a couple of minutes opening remarks on what they feel are the issues with, as it says, the opportunities and threats. And then I'm going to try and keep it maximum Q&A as possible. So let me go to my right, Lord Newby.
Thank you very much, Stuart. I mean, I think the opportunity is very clear in that with an increasingly deep single market in financial services and with growing economies in much of the world, despite the problems in the UK and Europe, the market for what the city does very well is potentially larger looking forward. The question, though, is whether the decisions at the Eurogroup meeting 10 days ago means that London's voice is going to be marginalised. And my view there is it depends on the UK's view. If the UK sort of sits like a vulture, waiting to pick morsels off the flesh of what they see as a disintegrating European structure, we'll get nowhere, in my view. We've got to engage proactively. And if we do, I think there's a strong chance for us to get a regulatory framework that we can live with. And if we can live with it, the city will prosper. And one of the fascinating things to me about the opportunities globally is that the challenge isn't whether Europe's going to do well. Europe almost certainly will do well in financial services, but it's which bit of Europe. And it's not necessarily going to be the city. And so the city is going to have to fight its corner very hard, but it's got to do it within a positive framework.
Great. Richard?
Thank you, Stuart. Well, I thought I'd just start off with where things are now. The thing we've all learnt in the last year or two is the interconnectedness of the international financial system, and particularly the international banking system. Actually, if one looks right now, and that's why a tiny little country like Greece can pose such a serious threat as it is doing today to the global financial system. Right now, the UK has done more than most to get its banking system into shape. A number of our European neighbours, for various reasons, have dragged their feet on recapitalising their banks. The UK has moved faster and stronger. The result is that Our banks here, the leverage ratios are lower than most of their continental peers. Their capital positions are stronger than they've been in a decade. Their liquidity is stronger than they've been in several decades. And thank goodness they were ahead of themselves in their financing programs ahead of August when things more or less stopped. The customer funding gap, as shown up in the bank's financial stability review, has more than halved over the last couple of years. So that's quite a good place to be. And our bank's loans to the periphery countries, well, Ireland is obviously a very big exposure, but overall our loans to the troubled countries of the south are modest relative to everybody else's. Over the last couple of months, I think it's fair to say that the Treasury and the Bank of England and the banks themselves have been working weekends to strengthen the resilience of them in these very, very difficult times. And so we can say with confidence that our banks are a heck of a sight better placed now than they were 3 years ago to face a storm, and they're better placed than they were in the summer. But if you take all that together, the fact still is that our banks are exposed to the tune of over £200 billion to the banks in France and Germany alone. So we are not going to be able to stand aside from the dramas that are taking place now.
Great. John?
I'd just like to make three brief points, really, and they echo some things that Richard just mentioned, and also the previous panel. I think the first thing is the sheer weight and scale and breadth of the regulatory reform agenda is proving quite daunting for the financial services industry, and its ability to be able to cope and respond to that is quite challenged. And what I see now is that they are slowly recognising this is fundamentally changing their business models, and this is not just banks. This is across all aspects of FS. So firms' ability to be able to cope with that and then re-engineer themselves and reshape themselves for this new reality is proving quite challenging. The second thing really is then this whole question of the role of banks and their capacity and their ability to lend to the real economy. I think there's one really important lesson for us to learn from the current reform agenda, and that's what market realities do to a very, what appears to be a very sensible and comprehensive capital reform and liquidity reform agenda. And what market realities have done is that they've compressed then what was a transition timetable, and they've actually then adopted new capital structures as being the new minimum for capital requirements for banks. And finally, also, the actual policy formation of capital is not yet even across the European landscape. So those three things have conspired together to actually then compress banks' capacity to lend to the real economy. And it's not just about the price, it's about their sheer ability to lend to the economy that we should all care about. The third area really is then the whole question about then whether there's any convergence of this regulatory agenda across the globe. And in some respects, it's very difficult to perceive there actually is. But if you look beneath the agenda, there is a slow but sure sense of direction headed in the same level of convergence. G20, the FSB, all point to large parts of the convergence. The pace might be different. The adoption of some aspects of the European regulatory model by the East might be different, but the sense of direction is the same. And that's another reality that global players, particularly in terms of the the UK FS space, have got to get used to.
Thank you for that, John. Jonathan?
The opportunity I think we have is in drawing the lessons from the 2008 crisis to actually get regulation which prevents things slipping through the cracks at European level. Luckily, not involving the UK, but clearly there is a strong need to, which has been accepted and is now being implemented, to get the famous single rule book across the financial services industry. The threat, if you like, of that is if the city is not sufficiently engaged. And there has been a lot of criticism in the past of lack of engagement. I'm impressed that that lack of engagement has changing. Whether it's changed fast enough and far enough is another matter. The other opportunity we have, but it is equally a threat, is the issue of global convergence. We are working on this the common G20 agenda, reinforced by the FSB, and that is moving forward. At EU level, what we are doing is implementing the G20 agenda, and there's also a lot of consultation across the G20 in terms of doing that at regulatory level, but the question does remain, we do need to ensure that the pace is kept up not only in the EU, which we have to, at EU level, but also in other key jurisdictions, because otherwise we do run the risk of regulatory arbitrage, even though sometimes that can be exaggerated for different reasons. Finally, I think the other big challenge, which is outside the regulatory area, is in fact to try to lift our eyes from the short-term crisis, which we're coping as best we can, to actually trying to, once we've restored stability, and that's right across the EU, also to try to ensure that we can restore growth and achieve competitiveness, because otherwise the long-term development of the EU as the biggest market in the world will not continue.
Right, Guntram.
Opportunity and threats to Europe. I want to argue that no matter how the Eurozone crisis gets resolved, it will have severe implications for the UK and the city. Of course, in the worst scenario, which I don't want to elaborate on, it's going to be disastrous for everybody. In the best scenario, which I think is still the baseline scenario we should be thinking about, is we will have the creation of a nucleus Eurozone finance ministry with an FDIC-like body that basically ensures banks within the euro area and is backed by, of course, contributions from Eurozone banks, but also, of course, ultimately the Eurozone taxpayer. And if we go that option, which I think is a necessary option to prevent the collapse of the euro, we will certainly have a difference between the UK and the euro area, because the euro area will have an FDIC which is backed by the euro area taxpayer, whereas the UK will have a very different backing from the UK taxpayer. And of course, this separation, which of course is already implicitly there by having a separate central bank, this separation will have effects on the costs and on the funding model of UK banks. So I think I agree with my friend and FT columnist Wolfgang Münchau that whatever will save the euro area will ultimately, and he put it of course very provocatively, destroy the EU. I'm not sure whether I want to go that far, but certainly we will have a clear two-speed Europe, which will have profound implications also for the financial industry.
Thank you. I think my major concerns about all the stuff that's been going on in the last 3 years, if you look at since 2008, roughly around the depths of the crisis, is that 3 years later, I don't think we've tackled the fundamental problem, which is if a bank went bust tomorrow, it would probably still ask for taxpayers' money to bail it out. So we've done lots of other things. We've had a whole range of regulation. We've had restructuring, not only in the EU, but also in the UK and member states. We've got a whole European supervisory architecture, European Banking Authority, European Securities and Market Authority, European Insurance Occupational Pension Authority, European Systemic Risk Board, but we haven't solved the fundamental problem. That if a bank went bust tomorrow, it would still ask for taxpayers' money. And as was said on the last panel, I don't think the industry themselves have been very good at reacting. When I speak to different banks, some of them say, you're absolutely right, but we're not very good at speaking to each other. Others say, I'm sorry, but you've got to recognise, in a sort of air of arrogance, some of us are too big to fail. And I think that's what we should have been focusing on. What we see is a whole host of regulation, not necessarily focused on that fundamental area. I spent a year working on the Alternative Investment Fund Management Directive aimed at hedge funds and private equity, trying to restrict the ability of European investors from investing in non-EU funds, which have done nothing to actually fundamentally affect that problem or tackle the main problem. And when I asked, why are we doing all this stuff rather than tackling the fundamental problem, and I apologise to those of you who have heard this before, I was told, well, actually, when a fight breaks out in a bar, you don't hit the person that started a fight, you hit the person you've always wanted to hit. And there are a lot of people, and there are a lot of people who've wanted to hit the hedge fund industry and the private equity industry. And we haven't tackled bank balance sheets. We haven't tackled the problem when I talk to financial engineers that they were incentivized to inflate bank balance sheets so they could book profits up front and then take their bonuses. We haven't tackled that problem, and we actually want to be seen to be doing things. My concern at the EU level is that the solution to the crisis seems to be more EU, more regulation, and I understand the need to fill in gaps, but actually sometimes we're looking at double regulation, and we're working at, if we change this here, we'll have to go back to another directive or another regulation and change that again, rather than looking for consistency and horizontal regulation. And I think for all of us, the challenge here in London particularly, and I say that as the only MEP for London who sits on the Economic and Monetary Affairs Committee of the European Parliament, we have to learn to engage. We have to learn the difference between the three institutions, the Commission, the Council and the Parliament, and understand the different motivations between each. Very quickly, the Commission actually is very technically oriented, and you can have those good technical discussions with the Commission. With the Council, it's both technical, because quite often it's national authorities or national ministries that seconded people, but then it becomes political when the political attachés get involved. And then you come to the Parliament, and it depends on who you talk to in the Parliament, but most of the debate is based on prejudice, ignorance, rather than actually facts, and it's rather frustrating. There are a number of MEPs who understand the industry, but there are a great number who vote on issues who have no real interest or are disinterested, and how do you build those coalitions with your colleagues across the EU in different countries to influence the three institutions?
Thank you very much indeed for that contribution there. Okay, questions. Let's throw it open for questions.
It's a fairly direct question.
You want to...
It's a pretty direct question, and I'll be very interested in each of your responses to it. Is the biggest threat to the UK with Europe that it thinks too much about Europe, and as a consequence forgets that out of 7 billion people, 1/3 of those people live in just 2 countries that are emerging at 7 times the rate that Europe is in terms of growth of GDP?
Right, who would like to take that one? Yes, Richard.
47% of our trade is with the Eurozone. Over half the funding of the City of London is for the Eurozone. Our banks are grotesquely overexposed to the Eurozone. It's no wonder we think about this place a lot. Clearly, we need to substantially increase our trade with the emerging economies, which remains modest. If you look at the numbers this year for China, India and Brazil, our exports are up about 50 to 80%, but from a very small base. But we can't not worry about the Eurozone when what is going on is going on.
Well, I'm not sure that we think too much about Europe. Richard is absolutely right when he talks about the economic importance, but your average citizen doesn't much care about the EU. Some of the media care a lot, and a number of MPs care a lot. But in fact, there are much more important things which are related to the EU, things like jobs, immigration, security, and this sort of thing. That's what they care about. They don't care about whether the UK is part of the EU or not. I know that wasn't quite what your question was, but people think of the EU in terms of this sort of amorphous body, which is trying to regulate everything that moves. And in reality, it's not the key concern of the average voter. But if the EU doesn't deliver on some of those key concerns, where, along with member states, along with the global system in some instances, then we do have a severe problem. Should we be worrying? Yes, we should be thinking also about India and China. They are certainly not negligible, but equally we should be thinking about the US. The 2 biggest markets in the world are still the US and the European Union as a whole.
I think there is an element, actually, in what you say of truth and worries, but I think that's because I'm shaded from where I sit in the European Parliament, surrounded by MEPs who go on about the European project all the time. and in fact, many ways, I think, adopt a very little European mentality to the world. And sometimes it comes out in our debates. When I was working on the Alternative Investment Fundamentals Directive and also the short selling regulation recently, and other directives and regulations when you look at third country provisions. And I say, why do you want to restrict the ability of European investors to invest in non-EU funds? Because that will reduce our returns, etc., and our opportunities. The answer I get back is, yes, but Europe's 500 million people. We've got a great market here. And that worries me sometimes. But I think we have to be concerned about Europe because, as Richard said and others have said, it's so much of our trade and so much of our markets here. But we are in danger of adopting a little European mentality.
The other point I would add, it's not just the economic element, but policy now is 100% Europe. So particularly in terms of financial services. So we need to find a way of better engaging. Our whole agenda in the past has been, we deploy our tanks on the lawns of Europe, fight the battle and then retreat. Well, that's not an engagement strategy at all. And that's not the way you'll change the sort of mechanisms we've been talking about in terms of the European mechanisms. And there is now more Europe, not less. And so therefore we have got to find a way of engaging better, shaping the policy that is good for the UK and good for London as a financial centre. But just to merely rock up and use the word no isn't a European language. They don't recognise that as engagement. So we have got to find a different way of adopting to the realities of now that European policy is UK policy for FS.
I don't know much about the UK, but certainly the EU is not thinking enough about the rest of the world. I mean, that is for sure. Brussels is basically not engaging enough with the big emerging markets, and that's a big issue. And I think we need to really work on that and stop. Basically solve our own problems and start really realizing what's out there in the world.
I don't think we engage enough with foreign. I think London and the UK is very bad. As we've heard, we've not been engaging on a consistent basis, even with the EU, and we need to do that. One of the things that strikes me, if you travel more than a few thousand miles from London, is the view of Britain from wherever is very different from the view of Britain in Britain. And it's a much less positive view in terms of our economic weight in the world. And I think there's a real problem that policymakers very often haven't had those conversations and have a falsely positive view about Britain's economic role in the world.
If I could just add, I think it's equally important to get out of Brussels to get a different view, because you tend to have a bubble vision wherever you're based. And it's very important to get to see beyond that bubble vision.
Right. I think perhaps if I could just ask one of the questions here. What is interesting is the attitude you find often now in Europe, well, us bloody Brits, which always says we want to do something different. I'm particularly concerned, obviously, about the post-crisis structure and the fact that the UK will be drawn, probably if it wishes to remain in the single market, into these rules. Now, if we take the financial transaction tax, Barroso's figures, I think, we'll call it 60 billion euros to be raised, of which the Commission would say something like 40 billion would come from London and go to Brussels. Now, I think the UK government might have a small problem with that. Of course, the other point is the other side of the Commission's thing was saying is, well, it will reduce GDP growth by 2% in Europe and will probably cost more to structure that because everybody will leave. In other words, all the hedge funds and everybody else will leave. But they won't be leaving from Frankfurt and Paris, they'll be leaving from London. So I just wonder if the panel have got a view as to how, in this particular context, we could stay outside of something like an FTT or whatever it is that is hugely detrimental to London and also comply with, if you like, the rules of the single market. Anyone to have a go at that? Richard?
Well, the UK will veto. There's no question
Yes.
about it, so that will happen. And Mr. Barnier was in town the other day saying, well, if you do that, we'll go ahead without you.
Yes.
And that may happen as well. I do think, though, that that there's a legitimate interest, to put it no stronger than that, in the rest of Europe in what's happening in the City of London. It is a legitimate interest because the IMF published some numbers a few weeks ago just demonstrating the size of the London wholesale markets in the European entity and the scale of the liquidity that comes from London across the European Union, and they concluded that the UK financial sector was a global public good which had the capacity to make the world a better or a much worse place. So if I was Mr. Barnier, I would be interested in what was going on here as well.
I don't think there's any question of that. And he said endlessly, and I think he probably said it when he was here on Friday, that we don't regard the City of London as an asset of the UK. We regard it as a major asset for the EU as a whole. I'm not sure I necessarily find my figures to agree with your figures. I mean, the impact assessments that the Commission did suggest that it has a negative effect of about 0.5% of GDP over 30 years. So that's a pretty small effect on an annual basis. And it would, on the positive side, also create a basis which should reduce the potential for preventing the potential of another crisis. So, which is a much more significant potential impact on GDP were it to happen. Richard is right, of course, that taxation is a unanimity issue. Quite how we then move forward, and I think there is a very interesting question because it's on the sort of cusp of the single market. How do you have a single financial services market if you have a significantly different taxation approach? I think we will have to wait and see what happens on that one.
Well, I guess the big issue is really, I think we need to have a bit of an outside view. I mean, certainly we need some form of stronger and more taxation for the financial industry, because that's what voters will call for. And, I think basically what we see at St. Paul's Cathedral, I think that's just the beginning. I mean, we are in the beginning of a phase of a popular backlash against the financial industry. And, for me, the financial transaction tax is basically one little thing that currently politicians think they can without much cost on the financial industry itself, impose, which is a symbol, which you can sell to your voters. And so if that is a big problem, which, we can debate about the numbers, then we need to think about some other taxes. But I don't think we will be able to have a world without more taxation on the financial industry.
I think one of the reasons there seems to be support, and I haven't seen the numbers exactly, for the financial transaction tax, is because we still haven't been able to. We're still being seen not to do anything about the fundamental problem. Going back to my earlier point about 3 years after the crisis, a bank went bust. It would still want taxpayers' money to bail it out. The taxpayers are saying, "Why are you spending money on the banks and all those rich bankers rather than anything else?" Depending on your view on the political spectrum. My friends on the left of the spectrum say that money should be spent on other industries. Those on the right of the spectrum, like me, would say you shouldn't be using taxpayers' money to spend that way anyway. In any other industry, if a business goes bust through its own fault, taxpayers shouldn't bail it out. A competitor should come forward, others will come forward. Why should the banking industry be any different? And you can have a system where you have a resolution that the bank, have an orderly wind down the banks, you have an asset sale, you make sure the payment system still continues so there aren't riots in the street when people can't get their money out of cash points. And you can we should have been tackling that problem. When I've had candid conversations with my colleagues across the political spectrum from other countries, it's quite interesting what comes out of these discussions. First of all, they say, look, they know the financial transaction tax doesn't actually tackle the fundamental problem, but it's being seen to do something. And politicians want to be seen to do something. And the financial transaction tax is an easy way of being seen to do something. And they actually admit it would not tackle the fundamental problem. And actually, depending on how the proceeds of the FTT, where they go, it could actually make things worse. If we put it into a resolution pot, just pay out for future banks getting into trouble, actually we suddenly create a system of moral hazard and encourage banks to behave irresponsibly because they know that quite well that it doesn't matter how they behave, there's money out there to bail them out. If it goes to the EU, well, as some of my constituents say to me, why are we giving more money to an institution that hasn't signed off its accounts for 16 years? That's not exactly a responsible use of money. So really, it's politics, and it is pure politics. It's being seen to do something, and I think it's because we've all been very slow in tackling the fundamental problem of banks seeing themselves as too big to fail and being bailed out by banks.
About the way that the Barroso leapt on the FTT is that I don't think he'd done it with any proposal that could disproportionately affect France or Germany in the way that it did for Britain, and it showed our lack of influence, which is a problem. Undoubtedly, any British government would veto it. And the Labour government made clear it would have done it, and this government would, if it's going to be a European measure. I think there is huge anger still about banking, but I think the only thing, or the most effective way of beginning to reduce that, is if the bankers reduce what they pay themselves. If we see bonuses and pay still shooting up, it will be virtually impossible to withstand political pressure for more taxation. If they were restrained, quite a lot of that pressure would ease.
Yes, ironically, of course, bonuses will be down 40% this year, but all the FTSE 100, which you call the real economy, pay will be up nearly 50%. So maybe the balance will shift. I'm going to have one more question. So.
I have a question to go to the point made by Syed Kamall, when he was saying that nothing has been done really in the last 2 years. Actually, we've come up with the Vickers report, which is, I think, viewed by most people as a good idea. And my question then to Mr. Scheele is, why is it that the European Commission does not agree with the UK imposing higher capital requirements? Why is it that the European Commission doesn't agree with maximum harmonization and only looks at minimum harmonization of capital?
Jonathan.
Well, first of all, we do believe in the maximum possible level of harmonization. Interestingly, what we've proposed in the capital requirements the draft capital requirements directive sets quite a high minimum, and it also allows national regulators to go beyond that for certain specific groups. So there is no difficulty in Vickers is perfectly consistent with what we are proposing in the Capital Requirements Directive. That is not how it's necessarily been understood, but it is so. There is not a conflict between what the Commission is proposing on capital requirements and what Vickers is proposing. And I think it's regrettable that however much we say that, and however much we suggest people actually look at what is said in the draft, it doesn't seem to get through in the rather simplified briefings which are sometimes produced for people at a senior level.
John.
It's quite important that when we look back and we might see that Vickers isn't just a UK solution. There's a growing interest in Europe in looking at structural reform in respect of Vickers. I was in Poland recently and heard the European IMF director talk quite openly about the fact that actually Europe should think very seriously about a Vickers type of solution. And I think the other thing to bear in mind is that Vickers is one part of the reform agenda in terms of restructuring agenda. The resolution and recovery plans is another, and actually the two things are one and the same agenda. And you'll see as much restructuring of banks, structural reform of banks, come out of resolution and recovery planning, and that will be a global phenomenon. So I think you'll see the solution tackled in different ways, but the end game will be the same. This is game changing for banks in the consequence of their structure, and that will come from across the globe. So Vickers will be one type of solution, but only one package of measures.
Yeah, the proposal on crisis resolution will be coming out before the end of this year, so you'll be able to have. Reference has been made to a blizzard. I don't know if it's a blizzard, but unfortunately the G20 agenda, which includes all of these issues and a number more, is a very big agenda. That was one which was agreed to by the G20, and it's a global agenda. And by the end of this year, you will have on the table all of the constituent parts which make up that global agenda. So wait till you see that before you say. I agree with Syed that we are not there yet, And I think if in a number of member states, the issue of crisis resolution is still very much a live issue if a bank were to get into difficulties.
I think, if what you say is true, I'm not denying what you say is true. I'm saying if the UK can go further, and there's this disagreement in the press, then I think Michel Barnier has to come out and say that.
We have said it.
And clarify it.
Frequently, on many occasions, and nobody wants to hear us.
And the other thing I think we have to recognise as well is that there is it's not only regulation. Actually, one of the problems we've got, in some cases, you could say some of the problems we faced, regulation was in place. It was a supervision and a quality supervision, and that's a much tougher question. It's not something that politicians can answer very easily. If you look at, for example, the whole CDO problem, and the fact that a small tranche of them were rated AAA, and they gave a AAA rating for the whole lot, whereas actually most of it was triple B or very poorly rated. The SEC were warned about that. But it was too complicated for them to understand the problem and dig into it, because the guys who warned them about it had spent 6 months trying to take apart CDOs and trying to understand actually what they meant. And it was too complicated for the regulators and the supervisors to understand that. And therefore, we have to understand the difference between we can have all this regulation, but if the day-to-day supervisors don't understand the problem, then we'll continue to have problems.
Good. Okay, well, thank you very much, everybody. We've now run out of time. Can I thank the panel, indeed, for their contribution, and yourselves. Thank you, everybody.